Sunny watched in horror as her life savings disappeared before her eyes.
A major fraud scheme has just been uncovered.
Financial fraud cases surge,
raising concerns about the broader
Who's
economy.
really behind the biggest financial
fraud at an all-time
a major fraud case with millions
Digital
of
fraud
dollars.
cases are rising faster than ever before.
My name is Rob Bezjan, and for the past 5 years, I've spent over 7,000 hours proving to regulators, and now to you, that Wall Street has been designing complex structured products based on mathematical principles for the sole intent of defrauding investors. How will I prove this to you? Simple. I'll show you how I profit by betting against these products. Welcome to modern day card counting. In this premiere episode, we're beginning at the end, where I summarize 5 years of being an SEC whistleblower, the methods I use to prove it, and invite you to join me in exposing this fraud. Let's go. My name is Rob Bezjan. In December of 2019, I became an SEC whistleblower regarding various exotic and structured financial product fraud, primarily leveraged exchange-traded products. On December 20th of 2024, just a few weeks ago, my legal team and I submitted my final report to the Securities and Exchange Commission. Over the past 5 years, I've dedicated approximately 7,000 unpaid hours to uncovering and proving what may be one of the largest financial frauds in history, all in an effort to protect you, the investor. I am legally represented by the same team that has represented other whistleblowers in some of the most notable cases of our time, including Theranos, Facebook, and Boeing, which has been in the news recently. Rather than start at the beginning, I would like to share with you the cover letter of my last submission, along with a few key pieces of information that I hope will help protect you, the investor. Let's begin. As you know, we represent Mr. Robert Bezjan, who submitted whistleblower tips in December 2019, January 2020, and July 2022, as well as supplemental information by letter concerning the risks and underlying fraud associated with leveraged and inverse exchange-traded products. We are writing to provide Mr. Bezjan's trading data and accompanying analysis that confirm his allegations through real-world data. We also provide some additional narrative analysis that Mr. Bezjan has created. Both are explained further below. Mr. Bezjan provides both in the hope that they aid the Commission in its mission. He is making this information public as well because he wants to warn investors of the real risk they face in investing in any of these products, and ensure that investors learn they may unknowingly have exposure through asset managers or investment advisors they are not directing. By shining a light on this dark corner of the financial industry, Mr. Bezjan hopes to put a stop to the manipulative behavior of the product issuers and the private wealth managers who mimic their practices with non-exchange traded products. Portfolio results. As we have previously discussed, Mr. Bezjan has been managing an investment portfolio created with the sole purpose of demonstrating that the design of these products inevitably favors the issuers at the expense of the investors. To do so, Mr. Bezjan created a series of investment strategies that were designed based on 1. His assumption of the deliberately designed scheme, and 2. Mimicking the process whereby investors are defrauded and the product issuers enriched. Although each strategy is different in general, they operate by trading in both pairs of the products in question, such that when the ETPs inevitably decline over time, they produce a positive return in the strategy via shorting or equivalent these products. The goal is to track and/or enhance the assumed behavior of the issuers themselves, who are profiting in the same way. In short, the issuers can only profit on these products to the extent of the aggregate amount investors lose. It is a zero-sum exchange. Mr. Bezjan has previously provided the Commission with what he calls the quarter quail model, as well as referenced other models in previous submissions. Mr. Bezjan is now providing the Commission and the public additional models that further demonstrate his claims. Mr. Bezjan would like for the Commission to specifically focus on his man-in-the-mirror model, which takes into account that the leveraged products are mathematically designed to decline more slowly than the inverse products. Like many of the critical aspects of these products that we have previously brought to the Commission's attention, this fact is omitted from the disclosures in the prospectus. The man-in-the-mirror model vastly outperforms the market's long-term returns while limiting the volatility of shorting these products to roughly a quarter of the market's beta or volatility. As previously detailed in previous submissions to the Commission, in early 2022, Mr. Bezjan raised seed money from investors, and without receiving compensation, i.e. with no management fee, Mr. Bezjan put the strategies to work. Beginning in March 29, 2022, after 2 years of trading, i.e. as of the day ending March 28, 2024, this portfolio had in aggregate yielded over a 53.3% gross return, compared to the S&P 500's 15.1% return. Performance stated accounted for 886 trades across 60-plus leverage exchange-traded products. This model and its results have been validated by outside, highly credentialed mathematicians who have demonstrated that the models will work not only with recent market experience, but when run virtually on past market results. There is nothing in the math behind these products that would indicate that the future will not follow the past, just as counting cards, if allowed, in blackjack works past, present, and future. In short, by mimicking the behavior of product issuers, Mr. Bezjan has achieved results that cannot be based on luck. Mr. Bezjan plans to showcase his models and trades publicly so that investors and the public will be protected. Along with this letter, Mr. Bezjan shares the details of his portfolio and its performance as corroboration for the allegations he has previously brought to the Commission. He has carefully maintained records for this purpose, attached are spreadsheets reporting the trades for the various strategies he implemented, of which the Commission now has 5 of the 13 he created, and screenshots confirming its performance. Additional analysis. Mr. Bezjan is providing for your review excerpts of the key material from his monograph, Structured Fraud, Strategies to Profit from Wall Street's Insatiable Desire to Defraud Investors, which he is also making public. The focus of his work is packaging for the public the analysis that he has previously provided to the Commission. Along the way, he updates some of his points and provides some additional commentary. In addition to the core of the fraud that we have previously discussed with you, this treatise raises 3 main points. ProShares. Mr. Bezjan analyzes the historical NAV market data to develop a very close estimate that ProShares has earned over $59 billion in profits since inception from trading the issuance and redemption of its products, with an outstanding liability of $44 billion as of September 5, 2024. Asset backing concerns. Mr. Bezjan identifies the potentially systemic risk if these products lack real backing, which would render them make-believe securities. This was the case with various derivatives pre-financial crisis. These products, just like the synthetic CDOs of a previous generation, depend completely on the solvency of counterparties. When one fails, it can cascade and destabilize the entire industry. This systemic risk was briefly detailed in Mr. Bezjan's first TCR and discussed in February 2020 in his phone conversation with Redacted and Redacted. Next fraud iteration. Covered call ETFs. JP Morgan's issuance of roughly $60 billion in these funds, JEPI and JEPQ, is highly similar to Redacted's beta products and similarly lacks the required disclosures. Mr. Bezjan also describes the methods of profiting from trading against these funds, an assault on investors that should prompt SEC action. In short, these new, exotic or complex financial products, JEPI, JEPQ, and similar, at best have undisclosed fees by way of mathematically engineered and guaranteed underperformance. Unlike leverage exchange traded products, Mr. Bezjan will be detailing how to beat these products immediately, with the goal of forcing action by the market itself to protect investors. We encourage you to review this and the other information provided. We hope that it will further your efforts to root out fraud within the exotic exchange-traded product space. That was a lot of information. Let's turn our focus slightly on 2 items. First, how we can follow along and track it daily to determine the profitability of these products. Second, how we can turn the tables and use the characteristics the issuers use to exploit the public to profit from these products ourselves with greater accuracy, lower risk, and higher returns than should ever be mathematically possible. In 2021, I said this:
A lot of bad actors are making billions, not millions, off of these products. And it's not just the issuing financial institutions. When the world learns of the fraud and can follow along in real time, the opportunity to exploit the public goes away.
And now I'm going to keep that promise and show you how you can follow along in real time. ProShares provides historical daily NAV data for each of its products. Simply click the download link and you can calculate the net issuance dollar amount and subtract the net redemption dollar amount, and finally subtract the outstanding NAV to come up with a very close estimate of the profitability of each of these products. If you do this for ticker SQQQ, a fund with $2 billion in current value, you will see that over $13 billion in net profit has been made. Question: how many operating companies globally have made that amount of money and actually have provided society a net benefit? The answer: not very many. As you continue that exercise for all ProShares leverage products, you will have a net result closely matching the one I outlined in the cover letter to the SEC. It's possible to take this information and trade on it and make a similar return that ProShare does. I will show the world how a little bit later. But remember, card counters aren't limited to making what the casino makes. They can do so much better. Enough so that if allowed, they would bankrupt even the largest casino. In 2021, I made this fantastic claim.
By mimicking what the issuers do, legally, it's possible to generate returns well in excess of 40% a year, every year. This, in my opinion, is the nail in the coffin of any defense of these products by regulators or by the issuers. This alone will eliminate the issuance of these products with or without SEC involvement. When the world learns of the fraud and can follow along in real time, the opportunity to exploit the public, which this fraud does, goes away. I can guarantee I'm not the only one that knows how these products operate. They were designed this way on purpose.
Allow me now to show you a dashboard we've created for the public's use that demonstrates the returns of not just the man-in-the-mirror model, but also the other models I provided to the SEC and are now published to the public with explanations in my book, Structured Fraud. It's my hope that this effort goes a long way in protecting the most vulnerable investors. As you can see, the man-in-the-mirror model drastically outperforms the market with a fraction of the volatility and drawdowns that investors would have had they invested in the market more broadly. It's almost like these products were designed this way on purpose. My first SEC whistleblower complaint was submitted in December of 2019, and my last report was in December of 2024. Let's see what the return would have been over that time period compared to the market. Over the past 5 years, I've done everything the right way. I've worked with the SEC, I've spoken to and presented to nearly a dozen different investigative journalists. I've tried to get academics and consumer advocacy groups involved, and not surprisingly, nothing has worked. If this fraud is going to be exposed, it's going to be done by the average investor who's fed up with being defrauded and is angry about it. Now it's time to open up my efforts to you, the public, and invite each of you to join me. I want to make it clear, because this fraud takes place in public markets, the public has full access to validate each of my claims directly. There's no need to trust or believe anyone else's opinion. I've provided a very clear argument to the SEC, and now you have access to that same information. In addition to my work, the dashboard, and my reports, I'm going to also open up a portion of my portfolio to demonstrate the man-in-the-mirror model in real time. This allows me to protect investors without the need or temptation for investors to risk their own money. Because this fraud is based on mathematical rules, it can be exploited for profit, at least until Wall Street lobbyists work with regulators to change the rules. If you believe in Ed Thorpe and card counting, you must also believe in what I'm sharing with you. The math won't change because you close your eyes, scream at the sky, and ignore the problem. Finally, I want to close with one last point I made to the SEC in 2019 and publicly in 2021.
All frauds must have a patsy. These products, in one way or another, must make their way into the hands of the unknowing or the ignorant. To the ignorant by marketing and promotion, and to the unknowing likely through advisors or being held on behalf of clients in advisory accounts or as part of a basket of products like other ETFs, funds, and the like. As the layers of this onion are uncovered, it will start to smell more and more like purposeful, deliberate, well thought out fraud.
With over $250 billion currently outstanding in the publicly traded products listed in my claims, it should go without saying that it's a mathematical impossibility for self-directed investors to be responsible for the aggregate purchases of these products. Logic dictates that the vast majority must be directed by managed money, much of which may be in violation of fiduciary responsibility. If this accusation is correct, I'm sure plaintiff law firms will dig quickly, as there is likely a multi-billion-dollar lawsuit waiting just for them. Lastly, I would like to invite you, the public, to walk through my work step by step. Linked in this video are more details. Cheers. I look forward to sharing more.